The information in this episode is general in nature and does not take into account your personal objectives, financial situation, or needs. Nothing discussed should be considered financial, legal, or taxation advice. Before making any decisions, you should consider whether the information is appropriate for your circumstances and seek independent, professional advice from a licensed financial advisor.
Welcome to the Defence Property Podcast, the podcast where we talk about all things property investing and real estate for Australian Defence Force personnel. Whether you're looking to build and scale a property portfolio or relocating across Australia, we've got the insights and tips for less stress and more success. Let's dive in.
And welcome back to another episode of the Defence Property Podcast, where we talk all things property and defence related. Today we have a special guest, Rob Creighton from Millennial Wealth. Rob, welcome to the show.
Thanks, Kane. Thanks for having me, mate. I'm pumped and keen for it.
Nice. So Rob's ex-military himself and now a financial planner, advisor. What do you go by?
I go by advisor, but they're interchangeable.
Yeah,
they mean
so-
the same thing.
Cool. So tell us about Millennial Wealth.
Yeah, sure. So Millennial Wealth is my own financial planning firm based up in Brisbane, but service pretty much all Southeast Queensland and around Australia as well too. Established my own firm a bit over a year ago after working in the financial planning space for a bit over a decade.
Yeah, nice. And ex-military, so tell us about the military career.
Yeah, mate. So straight out of school, I was 17 years old, signed the dotted line, joined the army, and I thought it'd be a pretty cool sort of career. Went into artillery. So you obviously know what that is, but for anyone listening that doesn't, basically firing big guns really long way and blowing stuff up.
Yeah, nice.
I did that for 5 years up in Townsville.
Yep.
And
Fort Field?
Yeah, Fort Field Regiment, that's
cool.
right. Which I believe, were you there?
No, so I was Ramey, as probably the audience would know, but actually got attached. So for anyone that knows, I went on the Rifle Company Butterworth or RCB
Malaysia.
trip.
Yep.
And I think Fort Field, one of the first units that went as an infantry unit that weren't infantry.
Yeah.
Could be wrong there. Happy to be corrected. But then they also took a section from 3 Sisby. So, a couple of mechanics or whatnot. There was a couple of ordnance in there, and we all went as infantrymen attached to Fort Field and spent 3 months in the Malaysian jungle. So
yeah, perfect.
It's pretty cool.
Good times.
Nice. What year did you enlist?
2009.
9 till?
2015.
Yeah, nice. Cool.
Yep.
And then straight into financial planning.
Yeah, effectively.
Yep.
So basically what I did was, while I was still in the army, I started my commerce degree just via distance education. And look, the army doesn't help you with that because it's not related to them. So I just did the usual thing and chucked on HEX like everyone else does. Yep. But started doing that, and then I started applying for jobs like pretty much everywhere, like Brizzy, Sydney, Melbourne, in financial planning, just as like admin support.
Yeah.
Landed a job in Brizzy and then moved down here, and the rest is history essentially.
Yeah, nice. Yeah. And so how long were you in these other businesses before starting your own firm or Millennial Wealth?
Yeah, so 9 years. So
cool.
Across those 9 years, I worked for 3 or 4 different businesses.
Yeah, sweet. And then fairly recent, Millennial Wealth was established?
Correct. September 2024 was when I officially launched that business and went out on my own.
Yeah, nice. And I believe we met. Where did we meet? Golf course?
Yeah, we met at a golf day.
Golf day. That's right. Yeah.
And that was when I was still employed, actually, before I'd even started my own business.
Yeah,
so,
nice.
Yeah, it was a couple of years ago now.
Yeah, sweet. Awesome. And I guess, well, to kick off, obviously we're a property buyers agency, defence property podcast. Just tell us or open up with, where does property fit into the greater wealth plan for, the average either defence member or person buying property out there?
Yeah, sure thing. I think it fits into pretty much everyone's wealth plan, or it should be in everyone's wealth plan, in my opinion. In the ideal world, if I had a client that had enough money and we had half their wealth in property and half in shares, that would be perfect. It never works out that way. But property is just such a great asset because, number one, the historical growth that we've seen in the property market, as you'd know, over the last 20 to 30 years has been absolutely phenomenal. And then the second part of that too is the amount of leverage that we can obtain utilising property is far greater than what we can with really any other asset. So the ability to keep tapping into that leverage to purchase more assets is something that I find really attractive as an advisor who wants to build clients' wealth over the long term. Yeah.
And we can get leverage, and they say, sorry, I'll just backstep.
Yeah, mate.
Leverage with compound growth is the 8th one of the world.
Correct, that's right.
And we can get leverage with other assets like shares and managed funds and that, but I guess the downside to that is obviously property is a lot more slow and stable. your shares and managed funds are slightly more volatile, but that is what impacts the leverage through a margin loan with those products. So I guess, you would potentially choose, and correct me if I'm wrong here, but choose to not have the leverage on the shares, managed funds and that, and bring leverage into the portfolio through that stable property piece. Is that am I on the right track there?
You're on the right track there. And how I look at it as well too, and how I often position it with potential clients is to go, well, if I've got $200,000 in cash, I can invest that in shares or I can buy a property. And now with 200 grand, I can probably buy a property close to $1 million. Whereas this shares, I can only buy 200,000 worth. And so if that property gets 10% growth, it's made me 100 grand. If the shares get 10% growth, it's only made me 20 grand, right? So it's just that power of being able to get those bigger returns more quickly, basically.
Singing off my song sheet
Mate,
here, Rob.
Yep, bang on.
Loving
So
it.
I knew you'd like that.
Yeah.
So yeah, exactly.
But I guess and I'm not going to deny that, shares managed fund obviously have their part of the portfolio.
Yeah.
My view is potentially build with property and probably have overexposed to property and underexposed in the early stages. And I would say, potentially as you do transition to some sort of retirement phase, and I'm not a financial advisor, so this is not financial advice. This is the property guy for educational purposes. But my views, so someone's got property, but where does shares and ETFs fit in?
Yeah, I think it fits in for most people, although what I probably would say is definitely the younger generation. They usually get a few properties under their belt first, just to build that equity and growth out. And then we look at adding some shares and managed funds into the mix. The reason why I don't mind having some shares and managed funds in a portfolio is it just adds that further diversification because, obviously, as you know, with property, you buy one or two properties in Southeast Queensland, that's your exposure and it's very concentrated. Whereas with shares and managed funds, we can obviously spread that risk around, like overseas, different sectors, different companies, and it's more liquid. And so that's why when we look closer to retirement, sometimes with some clients, and even recently I've been seeing this, is because property prices have been going up so quickly, they've been cashing out of their properties, taking the profit and pivoting that money into the more liquid assets. Yeah. So when they want to go on their 50 grand holiday, they've got the cash there to support it, right? So it's different phases of life.
Yeah. And I think you just hit it right. Probably the most common argument in the asset classes is the liquidity. There's a very common point or con against property that comes in the argument is that liquidity piece. But obviously shares and ETFs you can sell as much or as little as you need, whereas the argument is you can't sell a bedroom. As a property guy, I'm always going to make the argument that, if you've got $2-3 million of property, well, it's not really a line of credit these days. They're sort of a bit old fashioned, but, just equity release and have 500,000-600,000 and there's your liquidity there, but it's just not the same. So for the guys listening, the guys and girls listening, just talk us through that liquidity piece and kind of how important it is in the portfolio and probably why I guess that you would choose to maybe adopt shares and managed fund earlier to fulfill that liquidity.
Yeah, sure thing. Like you said, Kane, you can't sell a bedroom. And I always even go further and go, you can't sell a brick off your house and cash in. I mean, you probably could, but you probably wouldn't want to do that, right? So
but the key is, even if you could, it's not a far, so a real world example is like selling or subdividing the land and you could sell a chunk of it off. Yeah. It's still not liquid.
Exactly right. Whereas, with something like shares or managed, like shares in particular, right? Like they settle within plus 2 days. So if I sell shares today, I'll have the money in my bank account in 2 business days time. So it's very fast and you can literally choose, I want to sell 10 grand, 5, 30, 50, whatever it is. And pivot that into something else. For people that are accumulating wealth, I find that's not a massive issue in terms of investments. So that's why for younger people who've got long time frames, holding things like property is perfect because they probably won't need to sell it down. But it's definitely an issue for the people that are getting closer to retirement, or if they've got some other goal in mind where they're going to need a big chunk of cash soon, basically, is when we have that conversation. But I like to have both in the portfolio. So look, if we could have decent chunk in property and a few hundred grand kicking around in shares and managed funds, like that would be perfect.
20 days, yeah. And I guess on that liquidity, where it is important, and the younger you are, you could argue it's less relevant to older, but is unexpected life events. The life event occurs, whether that's injury, illness, things like that, change of employment or status. At best case, you're 30 days to settle the sale of a property. But you're going to have 14 to 30 to however many in preparation to go on the market. And then you're going to have your campaign, which depending on days of market with the suburb, which the audience would potentially be familiar with, have heard me talk about hot markets, days of markets less than 30, stagnant markets probably closer to 90.
Yeah.
So you could be 90 days in a bad market to sell your property plus 30 to settle. It's a long time before that money's coming through. And in the event that life event occurs, you've got your shares there, like you say, to liquidate in a couple of days and throw the money at whatever problem life's presented.
Exactly. And even when we talk about that too, having and where financial planners help us having all the appropriate insurances in place too, right? Yep. So if we are going hard into property, making sure we've got the income protection, the TPD, all that sort of stuff. So if you can't work because you got hit by a bus, you're going to have cash flow coming in as well too. So that protection piece is also super important.
Presuming you live through that bus.
Correct. That's
contact.
Right. If you die, well then you got life insurance for that, hopefully.
Sweet. Cool. So we've established I'm the biggest advocate for property, obviously been a buyer's agent, focus on wealth. And that's how we built a lot of our wealth. But let's go back to the start for, the current serving member or, even the veteran community that have separated from defence and they're saving for their first property. Just talk us through, kick off.
Yeah. Sure thing. So, I guess the three sort of ways that I see people save for a property is number one, the pretty vanilla, boring, chuck your money in the bank account, term deposit, something like that. Look, it's going to take longer to obviously build that deposit, but the benefit of that is obviously it's not going to go backwards. And some people would argue that it is going backwards because the rate of inflation is eroding your purchasing power. And because property markets move so fast, you're losing purchasing power that way. But it's still one of the safer ways of saving for property deposits. So that's step one, or not step one, that's option one, I should say. The second one is looking at some type of investment. So whether that's shares, managed funds, if you're got a really high risk tolerance, even things like cryptocurrency can come into that equation. The downside of using any sort of investment like that though, is say we've got a 2 or 3 year time frame to go and purchase that. If we put that money in shares or managed funds and we get to year 3, we're like, okay, cool, we've got our money ready to roll. And then the market drops 40%, then we're sort of like, well, we can't buy our property now because that's thrown a bit of a spanner in the works. So
100%.
I say to people who want to look at that, I'm like, look, we could absolutely do that, but you've got to understand that this could completely blow up your whole strategy.
Yeah.
So be very, very careful. The third option that I see people use, and I don't see them use it a lot, it's the First Home Super Saver Scheme. Basically, long story short, if you put extra money into your super and you go buy your first house, you can apply to release some of that money back out to yourself to put towards that first home. Again, the benefit is getting a higher rate of capital growth, or you'd hope, than what it would be in the bank. And because super is such a concessionally taxed environment, the tax is a bit lower. Downside of that is though, and I saw this recently with a client that came and saw me, was applied for the release, got the money out of super, market was too hot, didn't end up buying anything, ran out of time and had to put the money back into super. And once it goes back in, you can't get it back out. So sort of shot himself in the foot with that one. And that's where a buyer's agent would have come in handy for him to get that purchase over the line. So that's probably the main three. And then there's a ton of other different strategies around.
And there's obviously, a horses for courses approach to this.
Yeah.
But I think you mentioned something at the start about when we're talking about saving cash and that erosion of purchasing power. Obviously, depends on the time frame to save our deposit to get started and what we're saving for, whether it's, obviously there's a higher barrier of entry for an investment because we pay full freight on lender's mortgage insurance, stamp duty, and then the home purchase segregated to the local market. So whatever the local market's going to do, you're going to get. You can't pick your market Australia-wide for growth, but you can get in with a lower barrier of entry.
Yes.
Again, everyone has a different capacity to save.
Yeah.
And, obviously the store of wealth or the loss of purchasing power through saving dollars in the bank, if we're exposed to that inflation over 3-4 years to save your 5-10% deposit, it's a very real risk that we're facing.
Absolutely.
And then if it is potentially shares, if you're in 4 years, hopefully you can ride out that volatility event.
Correct.
So I guess, the shorter the time frame, potentially more appropriate the dollars in the bank.
That's right, 100%. Yeah, and I've even had people ask me, they're like, I've only got about a year or two to save for a deposit. Should I invest it? And I'm like, you can, but I probably wouldn't recommend it.
Yeah.
It's just not worth the risk, in my opinion, to completely blow up your whole savings capacity. Like if you're buying a principal residence, for example, obviously you can go in much lower deposits. A lot of banks have really good schemes for certain professions, that sort of thing. And, it can happen a lot quicker than if you're just going for a pure investment play, for sure.
Mm-hmm. And what about, so just touch on budgeting for us, like I know from being an ex-mortgage broker, obviously budgeting is important in the way, especially in the 3 months leading up to that application. But before we get to the 3 months of, leading into the purchase or the pre-approval, talk us just through general budgeting principles and guidance, I guess.
Sure thing, yeah. So I use the 50-30-20 rule, essentially, which you might be familiar with.
Yep.
It's pretty standard. It's just 50% of your take-home income is for, your living costs, so your rent, your food, electricity, all that sort of jazz. I like to use the 30% as my savings.
Yep.
And then the 20% as essentially like discretionary expenses, right? Funds type stuff. People have come back to me recently and said, look, Rob, like in this day and age, 50% on living costs, it's probably a bit unrealistic. It's probably much higher than that. And I would probably tend to agree because the cost of living has gone up so much. But with any sort of saving and budgeting, I've always been a fan of doing the percentage splits. And so that way, when your income increases, your savings automatically increase with it.
Yeah.
Whereas I think the issue a lot of people run into, and especially
it goes to spendings.
Correct. That's right. Bang on. It's that lifestyle creep, right? The more you make, you're like, oh, cool. Now I've got all this spare cash flow. I can go and do this and that and the other. But if your savings aren't going up at the same pace, you're really doing yourself a disservice, in my opinion.
I think lifestyle creep is very real in the defence as well, for the defence audience, especially when you're talking promotion, pay grades and things like that. Lifestyle creep is very real. But going back to the percentage, it's a very common 50-30-20, but I also like the 25-25, as in your 50% you split.
Yep.
And it could be 30-20 or 25, because 30%, rent.
Yes.
And that your big one, cost of housing.
Correct.
And then your balance, whether it's 25 or 20, being your bills or fixed outgoings, I guess.
Yeah.
And then your spendings and your savings. And I guess you can massage these numbers depending on if you've got one property already. You might have a higher or a lower percentage of savings. Or if it's an investment, again, it might be your savings could essentially be going to debt reduction.
Exactly.
What else do you see common with just sort of massaging those numbers and where people fall into?
Yeah, I think one thing that's pretty big these days is people get into the habit of signing up for like every subscription service under the sun, whether they're using them or not, and they don't realize it's costing them like $100, $200, $300 a month. And that's just money going down the drain that we could actually be putting into savings. Same with things like gym membership. There's all those little things just add up, even if you don't realize it. It's really important, I think, to get a handle on. And I say this with anyone, like cash flow is king at the end of the day, right? That's a really old school saying, and people are like, whatever, we heard it all before. But it truly is right, because in my opinion, the only way to save more money is to, one, earn more, and that's easier said than done, or cut your expenses down.
Yeah.
And for most people, cutting those expenses is probably going to net them the best result. And look, it's one of those things, right, where, you've got to realize, and for a lot of younger people who potentially are listening to this, like you got to make some sacrifices to hit those financial goals, right? So, I think the problem is these days a lot of people want everything now.
Yeah.
Whereas, you might have to save for a few years and not go out as much and not buy the nice cars and all those stupid things. And look, I'll be the first to admit, when I was in the army and, I had the V8 Calais, I had the R6 motorbike, spent quite a lot of coin and you'd know too, Kane, like pretty much every unit car park is just full of, I don't know what they're full of now, but in my time was like V8s, like everything like that, because dudes would just spend their money like it was going out of fashion, right? So maybe not doing so much of that and trying to save a little bit more.
But you can make the argument as well, it's a lot easier to get those things post, like when you are in an asset-backed position.
100%.
It's a lot harder to get the home after getting the cars and the toys.
Correct. Yeah.
You can still have the cars and toys.
Yeah, absolutely.
Obviously, budget and, assets and liabilities and all things considered, but it's a lot harder to get the house or the property after, loading up on the expenses and the toys and stuff.
Exactly right. And I'd even argue too, with some people, right, like a good strategy is to buy the assets first and then even use, like if you really want that car or the boat or the caravan, you can use the equity in the property to get that, because you're going to get it at much lower rates than if you went in for a secured car loan or something like that. So it works out better that way.
Yep. And I mean, I know you're a broker and neither am I. I've been a broker, but just as the 3 months goes into, or the 3 months before the application, just talks about what we're like, because like you mentioned, there's, Netflix, Spotify, all these, everything these days is a subscription. Nothing's an upfront cost or, compared. But what are we looking for in the, leading up with our expenses, leading into the pre-approval?
Yeah, I'd just say just tidy it up more than anything and cut away a lot of those things that are going to raise red flags with the bank.
Yeah.
Even like, I know it's pretty common these days and, as a broker, you might have seen it, Kane, like you see someone, there's always withdrawals at like pubs and stuff like that. That's because they're whacking that money like through the pokies, through their TAV. Like if you can, like get rid of that as well too in the 3 months leading up. Because again, when the banks see that, they're going to go, well, hang on a sec, like where's this money going? You literally spend it on gambling. So, just tidying everything up a bit. And like if anyone's self-employed, really important to talk to your accountant about your plans to buy property as well too.
Yeah.
Because often a lot of the times the accountant's job is to minimize the tax as much as possible, which will reduce your income as much as possible. And when that gets in front of the bank, they're like, well, you're not earning enough.
Every broker wants to maximize income.
That's
every
right.
Every accountant wants to minimize income. But with no income, you're not getting much of a loan. So there is that balance act. And it's probably important to have your broker accountant on the same team or page. So at least they're communicating to find that sweet spot if you are self-employed to minimize. Yeah.
Yeah, for sure.
Nice. Cool. And, that's gone on. We've saved, done whatever, we've got our deposit, we've gone on pre-approve and we've purchased property.
Yep.
Let's go down let's start with an own occupier and just talk through own occupiers and stuff, and then we'll probably segue into rent vesting from there.
Yeah, awesome.
But generally speaking, we've got a lower barrier of entry, especially with some of the schemes that we can touch on.
For sure.
We've got obviously military-specific schemes, HPAS, bit of a sugar hit, 16,000, 17,000, gets taxed.
Yeah.
And we end up with 10 or 11, depending on your tax bracket, post-settlement, which is important. It's not going to help you with your deposit.
That's right, yep.
But you can exhaust essentially all of your deposit and savings to the dollar, knowing that you've got a bit of post-purchase liquidity coming in.
Exactly.
DOHAS, we talk about quite frequently. But talk us through first home guarantee scheme.
Yep.
And what's that doing for, getting into your first property?
Yeah, look, it's doing a couple of things and I don't necessarily agree with it because I feel like, and you've always said it too, Kane, is that it's almost instantly made the cost of property increase overnight by them adding this into the mix, right? So, and look, I know it's better than nothing. And the fact, and correct me if I'm wrong, it's $1 million in terms of the property.
Different in states and regions and stuff, but let's, for point of reference, call it $1 million.
Call it $1 million, right? Yeah. So you can buy property up to $1 million. And a lot of people might say, well, yeah, Rob, I live in inner city Brisbane. How am I going to get a property for under $1 million? It's like, well, you got to look elsewhere if you want to take advantage of that, right? But look, I don't mind all those schemes if you fit the criteria. Yep. And that's probably the key consideration there. And if we're just talking owner-occupier, I think it might be a bit easy to fit the criteria because generally speaking, most of these schemes require you to actually live in that property for at least 12 months before moving elsewhere or doing whatever you want to do with it, where obviously you're investing straight away. Well, you're probably not going to qualify. So that's something there. But look, if you can get them, absolutely by all means get them. But I personally wouldn't build my whole strategy around the various schemes that are available if that makes sense.
Yeah. No, I agree. And you look at just on the scheme, like touching on how people ask, well, how did, creating this scheme open up the buyers, add 50,000 or 100,000 in purchasing price to each property. But if we look in Australia, we obviously have a lot of international migration. Yep. And that figure generally historically has been a lot greater than the figure of new dwellings that we are building. And we're not, that developers can, identify a site and build. We're not talking about mum and dad developers doing a duplex. We're talking about, large developments that are actually going to try and move the needle on the number of new dwellings. Right. And when that gap's only getting bigger historically, that's a supply issue. So we have a supply issue in real estate in Australia where we're not building them quick enough to meet demand. Hence, economics 101, there's an imbalance and prices go up. Yep. And then we create this fiscal policy where we stimulate the amount of buyer or demand activity on an already stressed out supply level. Yep. And all these buyers that initially, because there was income caps, there was price caps in the first home guarantee scheme, and essentially a lot of that's been relaxed, and that's that fiscal policy where all of a sudden overnight we've opened up the door to so many more buyers now where they're all competing and 2, 3, 4 offers per property. Yep. And there's your 50, 100,000 in a short period of time. Exactly. So again, people that have got property, it's great. Yep. People that are getting close and are opened up the door to them, it's helped. But it's all the people that it's left behind that's
exactly.
But essentially, we're getting into the market with a much smaller figure, aren't we?
Yeah, absolutely.
5% if we can fit into the criteria that you mentioned.
Exactly, and especially like might not even be for defence personnel, but like certain occupations, like a lot of professions these days, a lot of banks will let you go in with less than even 5% sometimes because they just know the earning capacity is so great in the future. Yeah. So, if anyone out there listening who might fit in that category, a lot of the time it's like medical professionals, lawyers, that sort of stuff, they can get in like really, really easy.
And I think I've seen recently a few banks and stuff offering 90% no LMI.
Yeah, I've seen that
huge.
As well. Yeah, it's massive.
I think Ubank come out and they said they're offering it across the board for investors and owner-occupiers.
Yeah, that's awesome.
Yeah. I mean, I don't know too much about Ubank, their policy rates or anything like that, but one does it. Hopefully we can see more.
Exactly.
Which is great.
For sure.
And then buying an investment property first, obviously there's a much higher barrier of entry because we are going to pay generally lenders mortgage insurance. There's no concessional rates or discounts on stamp duty. DOHAS, HPAS aren't going to apply. But that's sort of a good way into, I guess, let's jump into some pros and cons on rent vesting.
Yeah, absolutely. Look, I really love the rent vesting as a strategy, and especially more so for the generation that we're seeing coming through now, like anyone who's like 20 to 30 at the moment. And the reason why I love it is because number one, you get to live somewhere where you actually want to live.
Yeah.
So, whether that's in a city or the 10K ring around a CBD area. So nice and easy to get to work. You got all the amenities, everything around you. It's pretty good. Obviously, downside, you got to pay rent to someone. And then, of course, you're going to have that instability potentially if that landlord sells or, wants to change things up a little bit. But the other benefit too is it allows you to buy an investment property somewhere further away for a lower initial entry point.
Yeah.
And that's another thing I like about it because it makes it more accessible for you to get your foot in the door to the property market. And look, like, potentially you've got to buy, I'll give Brisbane as an example, somewhere out west, like out towards Toowoomba or Ipswich, which look, historically, they haven't been known as the greatest places to live. But I mean, if you're not going to live there and it's an up and coming growth area, and I don't know if it is, so don't take that as advice. Talk to Kane about that if you want to find that out. It's a good way to get a bit of equity built up and get started in that property journey. And then maybe over time, once you've got a couple or 2 to 3 investment properties, build up some equity, then you could leverage off that to buy maybe like your forever home, So
because you're not buying your forever home if you're a first home buyer anyway. It's very rare that
I mean, if you are, then good on you. Your parents are probably helping you out in some way, shape, or form. But most of the time, you're just getting your foot in the door, right?
And to give more context on that rent vesting, what it, I guess is choosing. Most people can afford to rent a lifestyle suburb and they can afford to buy. And if we to exaggerate the example, like the eastern suburbs of Sydney was a very high median household unit price there, but it's a lot more accessible to rent in those areas and then go invest in other markets. And if we jump into the data of a lot of those style suburbs, yields are probably 2.5%.
Exactly.
So it's a lot more palatable to rent there, and then go find a suburb with 4.5% and invest there and get a better yield on your property. And like you touched on, I guess you can open up, it's 15, 17,000 suburbs, depending where you get your data from in Australia.
Yep.
You can invest in any one of those if you go down the rent investing path, whereas if you buy an own occupier, somewhat at the mercy of the local market to grow.
Exactly.
What are some of the other challenges, I guess, for rent investing that you see?
Yeah, I think one of the other ones too is, as I mentioned earlier, just being at the mercy of the landlord. And obviously, most of the time they're going to try and put your rent up every single year. So that's an increase. And then also just saving in general, right? Because a lot of the time people, that's the old saying, rent money's dead money, which I think that's a bit of BS, to be honest.
Yeah.
Like I think you're literally just paying for a lifestyle and that's cash flow. So I wouldn't be too concerned about that. But I guess also too, potentially, if you do buy the wrong property as your investment property, then that can throw a spanner in the works for the future plans. And again, that's the value of a buyer's agent, is actually selecting the right property that's going to get you that growth, that's going to have the good cash flow so you can use that to leapfrog off into your next.
Build into the next.
Next phase of life,
And I think you mentioned something that's important to it is, I guess, considered a negative to the rent investing strategy is that you are exposed to the potential that the landlord's going to want a vacant possession to sell it or want to move in themselves. But also your current lifestyle is never your forever lifestyle either.
right.
That people go through being a single to being a couple to having children. And the property that you rent as a dinks, double income, no kids household is generally not the household that you want to rent when you've got family or children. So, it's quite easy to pick up and change a rental property of where you're living to meet your change in lifestyle where, it's a lot harder if you're living in a city, a unit or townhouse to then sell that. The transactional costs, as we know in real estate, can be quite large.
Exactly.
Hence that change in lifestyle expense can be quite large if we're going down the own occupier path. So
for sure.
Many benefits to the rent vesting.
For sure. And just quickly to add on to that, Kane, it's a really good example of why it's so good for defence members, right? Because you're getting posted around every 2 or 3 years. You're probably not going to ever live in one location I know some people get crazy long postings, but it's pretty rare. And so if you're and you get obviously rent assistance too, right, through defence.
Yeah.
So,
I'm preaching rent vesting to defence members. It's such a valid strategy, taking defence out of it. But when someone's going to pay 30, 40, 50% of your rent for you, depending on rank, region, marital status, all that. It's almost a no-brainer while you're in defence.
Absolutely.
And to give context or break it down, we serve for 20 years, say. We've got to remember that it's 20 years. 2 years to qualify for DOHAS.
Yep.
And then they've got 18 years. Say they buy a property on year 2 and they move in it, they get 18 years of DOHAS.
Yeah.
They've given up 18 years of rent assistance.
Correct.
Call it, depending on rank, region, marital status, but $400, 20 grand a year times 18 years. That's a lot that you've given up to own the privilege, your own home, when reality is there's not many people that will serve 18 years in one locality.
Nah.
Whereas if we then strategize out a little bit, we say we're going to rent for 20 years in defence and let defence pay us rent assistance for that period.
Yep.
We don't lose that 18 years of DOHAS. So then the day comes that we do decide to separate, whether it's voluntary, medical, whatever occurs, and we part ways with defence after our career. In that example, we've got 18 years of DOHAS where we can then buy the forever home. And if we were smart, we might have brought a couple of investments.
Exactly.
So then we've got 18 years or 20 years of rent assistance because there's no qualifying and forgetting about living on base and all that.
Yep.
Plus our 18 years of subsidy, as we walk out the door from defence. So strategy matters amongst all of this.
Absolutely. For sure.
Massive takeaway, I think.
Yeah, that's awesome.
Cool. Where to from here? Self-managed super funds?
Yeah, mate. Just another way that you can get access to property and build your property portfolio. And it's one of those things, I think it's quite underutilized because a lot of people with their super, they sort of don't really care much about it. They're not engaged with it because it doesn't feel like their money. But I can tell you right now, it absolutely is your money because at the end of the day, your employer, whoever it is literally paying you that every quarter, every month, whatever it is. And that's going into a separate account for you when you're over the age of 60 to access. And, for a lot of people at the moment anyway, like people I'm seeing coming through, like super is their biggest asset. And I'm sort of like, well, why aren't we using it properly?
Yeah.
And so if you want to be more engaged with your super and actually build it for your retirement, being able to buy a property using your superannuation money, I think is a really fantastic option for a couple of reasons. The first one is you got access to the money there already. You've already built that deposit. You don't need to keep saving to build that up if it's already exists. The second thing is how good the tax rates are inside a super. So while you're still building your super and accumulation phase, as we call it, the maximum tax you'll pay is 15%. And that drops down to 10% if you've held that asset longer than 12 months with the CGT discount.
Yeah, right.
If you hold that property until after 60, you convert your SMSF into pension phase and you sell that asset, there is no tax on it. 0%.
Excellent. Yeah.
So if you've held that property for 30 years and it's made $700,000, guess what? You get to keep it. Less sales costs, of course, right? So it's really cool.
I'm keen to dive into this more. I'm just going to jump in and say self-managed super funds are highly regulated.
Yes.
And there's a lot of criteria you must meet, not only in setting and establishing it, but in ongoing and managing it.
Correct.
So appropriate financial advice, appropriate accounting advice is critical to understand the environment you're going into.
100%.
And nothing that we're saying now is advice by any means. It's purely just a general conversation about what is a self-managed super fund and some pros and cons of it. So cool, got that out of the way.
Yeah, mate. Thanks for that. I probably should have thrown that in there as well too.
But yeah, so, we've got self-managed super fund, like just talk us through, like take property out of the equation, but we can essentially invest in many different assets and stuff.
Yeah, it's pretty wild. So like with the SMSF, you can pretty much invest in anything you want as long as it's set aside for your retirement. So I've seen SMSFs with like collectible cars, antiques, paintings, all sorts of crazy things. As long as it's within your investment strategy, then you can do it. The biggest caveat to that though is you cannot utilize that asset for personal use. So if you bought, we'll just use property, if you bought a property inside your SMSF, you can't rent it out to your mate, to your cousin, to your sister, to yourself. It's got to be on commercial terms, at arm's length. You can't touch the thing. It's purely for retirement, but it gives you that flexibility of being able to have those assets inside super that you normally wouldn't be able to. And actually, now that I'm going on a bit of a tangent, another thing about SMSF for property in particular that you've got to be careful of is if you're borrowing to purchase inside super, you cannot substantially alter or renovate that property, which I think that's a trap a lot of people fall into. They think, oh, we'll buy a fixer-upper on my super, you know, and we'll put all this money into it, make it real nice and get that capital appreciation on it. But you literally, it's against superannuation law to do that. A lot of the time in SMSFs, and you've probably seen this too, Kane, you're probably looking at properties that are reasonably newish, pretty low maintenance, good to roll already, rather than something that's like 30 years old that needs work.
And to give, I guess, context, capital improvement is different to maintenance. So we can maintain, but we can't majorly alter. And to touch on, we'll come back to the property, but just to touch on like what you mentioned about, you know, your exotic asset classes like vehicles, you know, remember highly regulated, must meet certain like arm's length tests, non-usable, all these criteria and stuff. So this is not something you would jump into not knowing what you're doing or without the appropriate advice.
100%.
And property is no different. So we can't go rent it to a family member like Rob mentioned or friends. We can't use it ourselves. A common one that we see or hear is I want to buy a holiday home down the coast and use it. Like, no, you are not doing that in your self-managed super fund. And when it comes to property, it's important to understand, I guess, the way that the borrowing structure and the limited recourse borrowing structure is established, that the strategy is also impacted. So in our personal names or outside of super, we might, you know, buy a property for 500,000, wait a few years, however long, it goes up to 800,000. We release some equity, we pull that equity out, we go have another bite at the asset class and buy another property using that released equity, get a new loan, and there's our second property in the portfolio. We can't do that in self-managed super fund. The loan is securely, I guess, isolated to that property. Just talk us through, I guess, the limited
So what Kane's talking about, limited recourse borrowing arrangement, or LRBA as people make the acronym for it. Basically, the reason why you have to set one of those up by law is so in the event that the property goes down the gurgler, you stop paying your payments and the bank's like, hey, we're going to come in and repossess this place and sell it. It's to protect the other assets in your super fund so it can't be completely cleaned out. So the limited recourse component of it is the bank's only got recourse on that actual property.
Which here comes the cash.
Yeah, that's right. Which, you know, fantastic. But the issue is you got to keep setting up multiple different structures to have that limited recourse arrangement, which costs more to set up, more to maintain and run. And then if you want to buy more property, you've got to set up an LRBA arrangement for each single one. So you could have 10 properties in your SMSF if you really wanted to. You just have 10 bare trusts set up with the SMSF itself, and the accountant would love you because they'd be raking in fees, but it would just cost a fortune, and then it would sort of start to negate a bit of that strategy anyway.
And you would have to be able to have the capacity to save the deposit for each one because you're not doing it the traditional way through outside the equity releasing.
Exactly right. And then another thing, sorry to cut you off, mate. Another thing people forget too is obviously, and I say obviously, but it might not be obvious to some people, because it's in an SMSF structure, you cannot claim any of those tax deductions or negative gearing for yourself personally.
Because it's a different entity.
Correct. That's right. So another thing to be mindful of as well.
And also, just because, so the limited borrowing limited recourse borrowing arrangement or structure is there to protect the bank if you do default on that mortgage and the bank has to sell the property, but also protects you that it can't clean out your super, as Rob mentioned. But just be aware that there is a personal guarantee somewhere in the terms and conditions of the loan. Yeah. So the bank will always get their money if 100%. You do default. So it's not an environment where you can go take this high risk property venture or something. No,
definitely not.
Very much for a set and forget more so than you would in your personal name.
And I'd argue with an SMSF property strategy is that it's probably going to be even more vanilla and boring than even a property strategy in your personal name. Because it's more of that very long-term buy and hold, like 10 years plus, in my opinion, is what we want to be doing in super because it's such a long-term investment.
Yeah, perfect. Cool. Excellent. So anything else on that while we're on super?
Oh, look, just get the right advice off the bat. I know people complain like, I've got to go pay a financial advisor and an accountant and a buyer's agent. But if you screw it up, you can be on the hook for a lot of different issues.
Cost to fix it can far outweigh the cost.
Unreal. And also too, like you lose all your consumer protections with the SMSF. So like say, for example, if you're in like, Host Plus superannuation fund and they screw something up royally, you've got a bit of protection there in that because they're a retail super fund. But if you screw something up in your SMSF and lose a bunch of money, there's nothing you can do about it. It's on you for making that decision. So at the end of the day, like what I would say is really do your research and contact the right professionals to assist you in deciding whether it's right for you or not before you pull the trigger.
Yeah, sweet. And there's probably a lot of people listening that are saying, I'm just not interested in self-managed super fund. It's not for me.
Which is fine.
Just talk us through sort of, maybe the current serving member, the veteran community and everyone else for people that aren't listed in.
Yeah.
What should we be looking out for? Returns, asset classes?
Yeah, for sure. I'd say for people that are interested in the SMSF, you really want to be very engaged with your superannuation.
Yeah.
So it's not as much of like a set and forget strategy as what you'd see through like a retail super fund where they essentially manage all the investments for you. It sits there, it ticks away, and that's fine. Someone who wants a self-managed super fund is someone who wants to take control over what they're actually investing in.
Yep.
And, build that long-term wealth that way. And if I link it back to defence as well too, some superannuation schemes, you can't even roll your money out into an SMSF. And what I'm getting to that for defence members is DFRDB and MSBS, what we call defined benefit superannuation schemes. And to give everyone the quick lowdown on that, what it is, it's based on a formula, your annual salary times years of service times a multiple times some other random numbers. And that's what figures out your end benefit rather than like investment performance. And you normally can't roll that money out into an SMSF. And, not advice here, but most of the time the defined benefit schemes are so good themselves, you probably wouldn't want to take that money out of it anyway.
Yeah.
And it's only recently, I think from 2015 onwards, Defence switched over to a new scheme called ADF Super, which is an actual accumulation fund, which is a completely normal super fund, which you could, potentially roll funds out. So, for anyone that served in our era or earlier, probably not something you'd be looking at. But for someone who served in defence from 2015 onwards, potentially that's an option for them.
But what about for, say, current serving or veteran community that they're completely not interested in self-managed super funds?
Yeah, I see what you're saying. Yeah.
What else could they be? What should they be looking at? Because for me, when I was younger, super was just something I paid no attention to and had no interest. And that's probably one of the things I look back on and should have proactively, because I didn't even understand what a defined benefit was back then. But what should current serving and even the veteran community, when they're considering their super, is it performing, is it not?
For sure. Number one, I'd say is what investment option are you in and is it relevant for your age and time frame to retirement? Because all too often I see people coming to me and they could be like 30 years old and they're in the balanced investment option, which is like 60% growth assets, 40% defensive assets. And I'm sort of asking the question, well, why do you even want 40% defensive assets? So that's like cash and bonds and really low returning stuff. And they're just like, because that was the default, right? They didn't know any better. Whereas for someone in that age range, you've got the 30 years until you can access it. So in my mind, I'd want to be really maximising the returns that I could get inside the fund. So that's a conversation that we often have with people, is making sure we're in the right investment for starters, then looking at like the fees and costs that are involved. You know, some super funds are sky high, and that can actually lead into the SMSF conversation, because a lot of retail funds, their fees are percentage based. So as your balance goes up, the fees go up with it. Whereas with the SMSF, they're dollar-based fees. So,
which is a huge consideration in starting it, isn't it?
That's right.
If you've only got a balance, if it costs, you know, 2.5 to 5K or whatever your accountant's quoting you to run a self-managed super fund, you got 100,000. That's 5% of it's 5K,
Correct.
which, you know, potentially is not feasible to sustain.
Exactly.
And you know, taking the leverage of property into, you know, that's a whole rabbit hole that you can go down or whatnot.
Exactly right.
But if you've got 500,000 there and it's $5,000 to run it, it becomes a lot more feasible.
100%.
You know, so smaller balances may be more appropriate, you know, or at least it has to be a consideration.
Yeah.
You know, versus what's the fees associated with the size of the fund at the moment. If you have a very large fund, you know, talking 1 mil plus or whatnot, you know, then potentially just minimising fees in
Absolutely.
Yeah.
Yeah, absolutely, it helps. And often a strategy we'll often do with clients is if they really do want a self-managed super fund at some point, we might just focus on building up their current super balance to a certain level and go, look, in 5 years' time when it hits $500,000, that's like our go time where we want to look at actually set up an SMSF and doing the property piece. But for now, we'll just make sure it's invested correctly, keep the fees low, and even like looking at additional contributions and things like that as well too. So there's plenty of different strategies we can layer in.
Yeah, cool. As we come to a close, Rob, I guess give us, you know, some insights, market outlook. What's your thoughts? What's going on? Just the Australian economy, wherever you want to go with it.
Yeah, mate. Yeah. I guess I'd start off with the economy. And, you know, the last few years we had those interest rates spiked and went up quite aggressively. And now they've come off the boil a bit and gone down. And the RBA, the last meeting that they had, said, we're going to keep them on hold for a little bit because inflation had actually started creeping back in, because people are, you know, feeling a bit more comfortable with their cash flows now and are starting to spend more again, which is a bit of a worry, because it means that if that keeps happening, we'll sort of end up in the same position where we were like 3 years ago, where inflation's sky high again, which no one wants. But, you know, from what I'm seeing personally, like there's still plenty of money out there. So there's still plenty of cash flow. There's still plenty of people coming to me that have significant asset bases that are looking for something to invest in. And I think like what you said at the very start of this conversation was with property, right? It's a simple supply and demand equation, right? So if there's too much demand and not a supply, well, prices can only go up. And in my opinion, like I'm not a builder, I'm not an economist, I'm in the construction industry, but I think over the next 5 to 10 years, I don't see property prices plateauing at all. I think they're just going to keep going up. And a question people often ask me, whether it's property or shares, they go, well, when's the best time to get into the market? And often I'm like, well, yesterday. Because, you know, ultimately every day or every week, every month, every year you wait to enter a growth market, whether that's property or shares, you're literally missing out on potential returns, right?
No, it's opportunity cost. You know, the opportunity you've missed by sitting on the sidelines.
Exactly. And, you know, people are always like, we'll wait for the dip to happen. But the problem with that is the dip never comes. And then
you get him priced out of the market.
Exactly.
So much. Yeah.
It's just like, it annoys me sometimes because you got all these people on like social media and stuff going, just time the market, do this, do that. But it's like history that just shows us if you buy and hold for a long enough period of time, no matter what asset class, generally going to end up in a pretty good position. And I know that's not the funnest or sexiest way of investing, but it's what gets results.
Yeah.
And ultimately that's all I care about is results.
Investing shouldn't be sexy.
That's right.
For sure. It should be long and boring and that.
Exactly.
A thing that you mentioned, like interest rates, one thing that I like to look at is where the fixed rate sit compared to the variable rate.
Yep.
And, you know, and you can sort of make your speculations on where rates are going, but you can seek your confluence from where the current fixed rates. And I think if you look that you would note that they're quite close to, still under the variable.
Yeah.
So obviously if the bank thinks that, you know, rates are going up, they're going to put fixed above slightly to cap you at some sort of level before, and vice versa. So if fixed rates are sitting below the variable, you know, they're thinking they're going down.
Yeah.
But the closer they are, there's probably, and I think previously they've been quite below, but now they're coming back to a lot closer, which would tell me that, you know, the banks are thinking that we've possibly not reached, but, I'm personally not expecting 1.5%, 2% decrease from where we are.
Not at all. And I feel like that would just fuel the fire too much in terms of inflation.
Yeah.
Because people would just be spending money like it's going out of fashion. And not to mention that would obviously make the property market even more competitive than what it already is if rates were to drop that much, because everyone's lending capacity would obviously increase. So yeah, it's a tricky situation. And people often ask you like, I'm a first home buyer, I've been struggling to get into the market. Like, what should I do? I'm like, look, to be honest, like find a good buyer's agent who can help you get the right deal and negotiate on your behalf. Because that's probably the hardest thing about purchasing property, in my opinion, is like actually the negotiation part when you've got, especially in hot markets like this, where you've got 10 different offers getting thrown in, like it's just crazy. And you'd be able to say more in this, Kane, but like a lot of people say that like the property that hits realestate.com is what buyer's agents have already passed on, right?
Yeah.
So it's not necessarily the good stuff anyway. That's where the value of what you guys do comes in massively.
And speed, getting into the market,
Correct.
Minimising that downtime, like you touched on at the start of the episode, like the longer you have, savings sitting in the bank, it's potentially at risk of that loss of purchasing power.
Exactly right.
If you can do it yourself and get in the market in 12 months versus get in the market in the first 1 or 2 months, whatever the market's moved, 5%, 10% in that period, that's the opportunity cost of what it took. But
exactly, 100%.
Rob, will be here all day.
Yeah, mate, I could talk all day.
Where can people find you?
Yeah, pretty easy. So on Instagram and TikTok, on Millennial Wealth AU on Instagram, Millennial Wealth 1 on TikTok. Also, you can just jump on the website, millennialwealth.com.au. And I'm very active on the socials. I do TikTok live streams, all sorts of stuff. So if you're keen for that, jump on and give us a follow.
TikTok live streams,
yeah.
Don't forget amongst it.
Mate, it's good fun. It's really good fun.
Awesome. Well, thanks for having us. If anyone misses those details, reach out to me and I'll put you in touch with Rob. Keen to get you back on, Rob, but thanks for your time today.
No, thanks, Kane. Really appreciate it, mate, and love your work.